In this free video course, I will introduce you to the fundamentals of chart patterns used in trading various markets, including stocks, Forex, crypto, and other financial instruments. These patterns are universal, making them applicable across different markets and timeframes. Throughout this course, you will learn how to identify and classify chart patterns based on their characteristics. We will explore the distinctions between reversal, continuation, and neutral patterns, as well as the differences between bullish and bearish patterns. Additionally, we will analyze the underlying logic behind each pattern and explore multiple strategies for trading them effectively. Toward the end, we will discuss the overall practicality of chart patterns, examining both their benefits and limitations. The primary objective of this course is to provide a realistic perspective on the use of chart patterns, a topic often misrepresented by trading educators. While I personally do not rely heavily on these patterns, I believe it is essential to understand both their strengths and weaknesses. That is why I created this free course, to serve as a reference for traders looking to gain a well-rounded understanding of chart patterns. Before we dive in, please note that this video, like all content on my channel, is intended for educational purposes only. It does not constitute investment advice. Always trade at your own risk. Now let's start by understanding the classification of chart patterns. The classification process is similar to that of candlestick patterns. There are two primary ways to categorize chart patterns, and they work together to provide a comprehensive understanding. These classifications are based on direction and type. The first classification focuses on direction, indicating where the price is likely to move after the pattern is formed. Since price movements are confined to two directions, the pattern will either signal an upward, bullish, or downward, bearish trend. A bullish pattern suggests that the price will rise after the pattern forms. A bearish pattern suggests that the price will fall after the pattern forms. The second classification is based on type, which further refines our understanding of the pattern's impact on price movement. There are three main types: reversal patterns. These indicate a change in direction. If the price is rising and a reversal pattern appears, it suggests a downward movement. Conversely, if the price is falling and a reversal pattern forms, it signals an upcoming upward move. Continuation patterns. These suggest that the existing trend will persist. If the price is trending upwards and a continuation pattern appears, it indicates that the price will keep rising. Likewise, if the price is moving downward and a continuation pattern appears, the downward trend is expected to continue. Neutral patterns. These patterns do not provide a clear directional bias. Instead, the price movement depends on which side the price breaks out of the pattern. If the price breaks upwards, the pattern suggests an uptrend. If it breaks downward, a downtrend is expected. By combining these two classification methods, we gain deeper insight into market movements. For example, a bullish reversal pattern signals that the price was previously falling but is now likely to rise. A bearish continuation pattern suggests that the price was declining and will continue to do so after the pattern forms. A neutral pattern does not depend on past trends. Instead, it signals that price movement will be determined by the breakout direction. If these concepts seem unclear, don't worry. They will become more intuitive as we explore real-world examples of each pattern. Let's now move forward and analyze the most significant chart patterns, breaking them down one by one within their respective classifications. Hope you understand these concepts one by one. We discuss all major concepts of trading, which help you to understand the chart's pattern.